Okay, traders, as promised, um, like it says, this is going to change the way you view the markets. This is a game changer. You will never see the markets quite the same way as ever again, because what I have here is very unique, is very interesting, and is very simple to follow. Now, we're on the Australian US dollar, the AUD USD. Now, this strategy can work with any chart, doesn't matter. So, what we're going to discuss is the 20 period moving average. So, those of you who have a trading view, you can go to the trading view tab and go to charts. And then what you want to do is go over to the tabs once you get to the charts. And then you want to look for, I'll show it to you in a second. You want to look for the SMA or the MA. It doesn't matter. So the first thing that we do, we want to go over to indicators, and then you want to type in either the MA or the SMA. But for this illustration, we're going to select the SMA, which is the smoothed moving average in this area. So this is what you want to get. Now, when you click on that, you go to the charts, and then I already have it on my screen already. So you want to click it on twice, right? This the SMA 20. Now the first one, it's going to be, you want to select it to where it says source to low. All right, and then on the second one, you want to click on where it says the source is going to be close. All right, so it could be either high and the close or low and the close. It doesn't matter. So, on this chart, we have the low and the close of the 20 period moving average, the SMA. And as you can see, it kind of, channels out at first glance what the market is telling you, right? So it gives you a instant visual of where the dynamic support and resistance are. So on the Australian US dollar, we see that the price for the long run has been bullish, right, for the most part. And as we can see, price action stays above the line, both lines, and then it'll kind of meander a little bit and start going sideways. And what you'll see is a test and retest of the bears. So you can see where they start to step in and push price action gradually, where it's trading below both the 20 period close and the 20 period low, and to the point where you see how it bends and starts to curl to the downside, right? So this is powerful, guys, because now you have a tool in your arsenal where it'll tell you, okay, here's the probabilities of where the market is going to go, okay? And not only that, but we have other tools in our arsenal. We have, for example, the CCI 14. So on the trading view chart, what you want to do is set your parameters to 14. Now the other stuff, don't worry about it. It's not that important. What you want to do, where it says length in the inputs for the CCI, you put in the 14 on there. So you would go to the menu where it says indicators and type in the word CCI. Now the CCI stands for the Commodities Channel Index. So it gives you the index of the price action, as long as, and also the relative strength of the markets and the momentum, which is more more important, right? So it gives you the momentum of the move, unlike the RSI. So the RSI is considered a bounded oscillator. What does that mean? It means that the RSI has limits to how far it can go, and as far as oversold and overbought. However, the CCI gives you the probability or the potential pivot of the markets. So if you can look in this area right here where my cursor is, you can see how the CCI oscillator, that the line goes below this bottom line, which is called the negative 100 line. And once you see the line goes below the negative 100 line, what do you see? Now, the price action will tend to want to be bearish, right? So we're in a bullish market. So I'm looking for buys. I'm looking for the probability of where the market will go, right? So if we can go back to the beginning of this chart, all the way back, as we can see with the CCI, price action dipped. It came off of the 20-period moving average zone that we created, and it went down, right? But we're a little skeptical because we're not sure exactly how far it's going to go. So yeah, this would be a nice little scalp move to the downside. However, just to be vigilant and be, very wise to what's really going on, we use the CCI to give us a clear path of what is really going on with the price action. So yes, you would have probably shorted in this area. It's a good area to go, but the momentum of the move slowed down a little bit. So from this point to this point in this area would be the ideal place to put your shorts, right? But please understand that we need to watch this very carefully, because what's going to happen is that it can continue on, or it can turn around and stop you out. And so the CCI, as when you see this curls to the bottom and retest the negative 100 line, we notice that the bulls started to step back in again in this area. So the CCI is a really wonderful tool when it comes to that, right? Whenever you see this, guys, you know that there's a strong probability that there's going to be a pivot or a market change. And the wonderful thing with the CCI is that it gives you the opportunity to get into the market earlier than the other retail traders that are looking for either to go long or short, right? So we got in pretty early. So what you would do is you would put your stop loss right below this area, and then you would have got into the market, and then you would have rolled it up to where you see the zone. Now please remember, whenever the price action goes into the zone, you know that there's going to be some kind of resistance. So please be prepared. All right. So what we want to see ideally is that the price action goes above that zone that we created, and this is where you would add to your position, and you would continue up. And then as price action continues, you would move your stop loss one candle behind. So for example, this candle shot up, and then it closes, and then another one started. This is where you would put your stop loss. So let me just draw a line for you guys so you can see what I'm talking about. All right, this is where you want to put your stop loss, in this area. And then a new candle would have opened up, and then we continue. And then what you want to do is that as soon as one candle closes, so we probably would have gotten stopped out. So we would have already moved our stop loss up, and probably got stopped out in this area, but that's okay. We can always go back into the market again, right? We can always go back in and trade again. And sure enough, we went back and retested the 20-period moving average zone, and then went back up again. Now, another tool that I use is the 8-period EMA. So whenever the market is starting to trend, what I would do is also put in the 8-period EMA as well. Give me 1 second here. Let me put it up for you guys so you can see what I'm talking about. All right, so this is the 8-period EMA in this area. So we can see that the price action actually tested the 8-period EMA, and it continued up again. So one of the cool things with 8-period EMA is that price action respects the heck out of the 8-period EMA, and so this will be a guide for you if you were to trade this particular instrument, which is the Aussie US dollar. All right, so that's one example, right? So let's go to NQ. Let's see what NQ is doing, for example. All right, so I took a trade earlier because it broke structure. It broke the zone in this area, and as you can see, we entered around this area, right? And so this is the Nasdaq 100, the E-mini futures, and we took a quick short in this area, one contract, because overall this market is still bullish. Let's go to the 2-hour chart. As you can see, we're still in bullish territory, but short term, if you were a scalper, if you drop down to the 5-minute, as you can see, the 20-period moving average zone has curled almost at a 45-degree angle, and that's where you want to put your that's where you want to place your trade if you were going short. Yeah, so family, if you guys enjoy what you're seeing, if you love the video, please like and subscribe. I want to apologize for the technical difficulty that I had before. I was in the middle of showing the video, and then we had a lightning strike, so that kind of disrupted everything. But now we're back in the full swing again. All right, so we're just going to continue with the 20-period EMA, the 20-period SMA rather, the low and the close. All right, and we're going to go over some more examples of that. All right, so please like and subscribe. All right, let's continue. All right, guys, so we're on XRP USD on the 30-minute chart, and the same thing goes for the 20-period moving average, the high and the close, or the low and the close. All right, so this is XRP USD. This is a crypto pair that's pretty popular, and the same thing works just as well, right? So we can see at the bottom here we have the CCI, where it dipped down and came back and touched the negative 100 line in this area, and as we can see, it shows that there is a momentum to the upside. So the bulls stepped in and pushed price through the 20-period zone and beyond, right? And then we have a pullback into the zone again. So we can see that there's some sideways action going on. But yes, you could actually use this example, right? You can use this to scalp the market. So we can go down to a lower time frame, for example. Now, as you can see, same chart, lower time frame. You can see in this area, as an example, we see that price action went above the zone in this area, and we're using the 8-period EMA, which is the red line. So price busted through the zone, and we see we have a close above in this area. So this is where you would have taken the trade, right? And you would have put your stop loss in this area right here. So as price continued upwards, so for example, let's say in this area, the candles close in this area. This is where you would put your stop loss in this area, and then as the price action moved up, you would follow through where you have a one candle stop loss. So, for example, we have this big push in this area. We would put our stop loss right here, right? So, let's say in the future, what happens is that price came back, and we probably would have we probably would have moved our stop loss up in this area and probably gotten stopped out somewhere in this area, right? So the main thing is that we should do proper account management. We gotta limit our risk and increase our profits. So yes, you're gonna have some bad trades. You're gonna be stopped out. You're gonna be stopped out in profit, and sometimes you will stop out out of profit. So the key is to, for example, lose $1 and make 10. That's it. So proper account size management is very, very important. All right, but besides that, the same thing in this area. We see the breakout again from the zone, and of course the 8-period EMA, which is, in my opinion, golden. Do you need it to trade? No, but it makes a very good guideline for price action. So we can, for example, take it off. It looks like this. So if let's say if we had no 8-period EMA, this is what you would do. You would just hold your position, move the stop loss one candlestick up at a time as it goes up, and then this would be your barrier, right? This would be your the zone of where if price action should go to the downside and break through this zone, then that okay, it's time to get out in the market and just reassess and see what it's going to do. We never do any kind of knee-jerk reaction when it comes to trading the markets. Okay, guys. All right. So just to give you another example, let's go to Bitcoin. Let's have a little fun. Let's go to Bitcoin and see how that looks. So BTC USD. All right. Same scenario. So this is the 5-minute chart. Let's say that you want to be a swing trader. You would go to the 10, the 1 day rather. So each candlestick is 1 day. So let's say all the way back here, for example, you notice that price kept going down, and of course the bears were in charge for a little bit, and you notice that okay, you probably would have probably gotten it in this area, and then you would do the one candle away stop loss, and you probably would have stopped out in this area, right? Probably would have stopped out here, but that's okay. We don't just go by the price action around the 20-period moving average zone. We also use other confirmations. For example, we would use the CCI. We noticed that for example, we would see visually that the CCI went below the negative 100 line in this area, and so you would probably put in a order to go short. However, we want to look at the higher time frames and see what's going on. We see that okay, price action on the weekly is we're bullish. So I want to be looking to short, guys. I would be looking for opportunities to buy, and so I would put my trades in this area, and put my stop loss maybe somewhere below the area in this zone, and then of course continue on. So yeah, guys, trading should not be overcomplicated. It's really simple. It's a little bit of art, a little bit of science, and of course learning your basic fundamental for that particular asset also helps too as well. Now by nature I'm a market technician, right? But it's 80-20. So 20% for me is fundamentals, and 80% is really technical analysis in my part. For the most part of my career, this is how I trade. I do the market setups, I've learned along the way with my mentors certain techniques. Like this is one of them, which is the 20-period moving average. And so pretty much what I did, I pretty much expounded upon what they taught me about the 20-period moving average. And I say, okay, well, how about instead of having a line, we have a zone. So that's pretty much how I trade. So I see the relationship between the market price action and how it is in relation to the 20 period moving average zone. All right, guys. So we'll continue more on this. All right. On the next video, we'll talk more about the CCI. We'll talk more about the momentum squeeze by Lazy Bear on TradingView, which is the color coded green and red line, light green, dark green, and we'll go more into that in our next video. So guys, thanks for watching. Please like, subscribe, and we'll see you on the next one. Okay, bye-bye now.